working with a lot of larger private equity clients. I was also surprised that some of the industries they were targeting. To your point on the manufacturing, I worked with one private equity firm who bought a series of plastic manufacturers in California as part of a roll-up strategy. And then a few months later was working on software deals. So definitely a combination of the expertise with the PE firms, as well as like what their strategies are. For the parties involved, the process is pretty similar. As you know, I've had the pleasure of listening to a lot of your guests, great M&A folk and discussions. It really is a combination of who are the parties involved, what are their motivations, what does their time frame look like, and then really starting at an LOI or preliminary negotiation, conducting comprehensive diligence, and then negotiating a fair purchase price. So both parties walk away giving up some concessions and then ultimately fair purchase price. What is this value worth, et cetera? Ultimately, in Main Street lower middle market deals, it comes down to market comparables in the last 12 months of what similar to alike businesses look like, assuming you can find, let's say, a handful of businesses that make sense from an optics and strategy space. Really, it's fair to assume that the purchase price should be in line with what others were willing to pay. That's just a simple fundamental capitalism and market rule. What kind of market are you targeting? What sort of businesses? Assuming that's established, discuss kind of what's the pipeline look like? How are you going to find these deals? If they have a team that works with them. If not, there's several channels such as private off-market listings, marketplaces, biz buy sell, et cetera. And then it's understanding how they're going to finance the deals. If they want to do a few transactions, it could be quite expensive. Do they have private investors, lenders, et cetera? What does that capital look like? Because once these businesses are identified, it's a first come, first serve. You sometimes have to move quickly, at least in the early phases. So it's understanding what they can afford to purchase, et cetera. And then having the other levers to pull, such as due diligence providers, lawyers, deal team, et cetera, to quickly execute on the transaction in the early phases and then check off all the boxes to ensure the investment makes sense. The business look like in 12 to 24 months based on what the buyer's criteria was. Are they looking, is this their first purchase? Is this part of a larger strategy? Does that strategy make sense in terms of the other things they purchased? There's a lot of elements depending on who's buying the business and what they're really looking to leverage off of it. Work with clients, identify companies to purchase, analyze them, work in the LOI phase, conduct comprehensive diligence, negotiate purchase price on their behalf, and then more importantly, stay on in some capacity in the first 1 to 90 days. We've found, and our clients hopefully can speak to the same benefits. Providers or acquisition advisors are often the second or third closest person to the buyer themselves, given they've been significantly invested on a time basis, understanding the business, some pitfalls and possible synergies. So we will work with our clients in those first 1 to 90 days to make sure they're just setting themselves up for success in the long term. You know, it was two partners working on a business and they unfortunately were separated. So it just didn't make sense for them to continue operating it together. Some want to just really retire. They're sort of burnt out from the 30 years of being in business. And then others just want to do something different. They're ready to move on. They have multiple businesses and they just want to sell off one of them.